A very good morning, afternoon, or evening, as the case may be, depending on the country you're based in, and welcome to this webinar on sanctions organized by Fintelekt and Asian Bankers Association. My name is Shirish Pathak. I work at Fintelekt, and I will be your host today for this webinar. At the outset, let me thank the Asian Bankers Association for partnering again with us for this webinar. As many of you know by now, in light of the global situation, we have increased our webinar schedule from once a quarter to once a month, and I hope this will add value to ABA members across Asia. I believe the banking industry has found this useful as well, and the fact that we have over 700 participants in this webinar today is a testimony to that. Today we have four guest speakers: Hala Alwan from HBA Consultancy, Vincent Gaudel from Accuity, Nicholas Turner from Steptoe and Johnson, and Surendra Thapa from the Global Intelligence Analysis Corporation. All of our speakers are available on LinkedIn, and I would urge you to connect with them after the call should you wish to get any more advice from them. There are a number of key issues related to sanctions that we will discuss on the webinar today, namely the evolution in sanctions over the last few years, recent trends in the sanctions environment, what is the implication of sanctions on how banks conduct or should conduct business, how can banks keep track of frequent changes on global sanctions lists, and key considerations for banks' sanctions compliance programs. We will attempt to take questions from the audience at the end of the webinar. However, online platforms, including this one, are facing a severe stress of overload at this point in time. And just in case it doesn't work out logistically, please email your questions to us at contact@fintelekt.com, and we will try our best to get our guest speakers to answer questions offline for you via email. Hala, Vincent, Nick, and Suren, thank you for joining us today. Let me begin by posing my first question to Hala. Hala, OFAC sanctions have been increasingly complex and rigorous over the last few years. Penalties have increased manifold, and tolerance to violations seems to be going down. The impression many banks in Asia and in other parts of the world have is that sanctions risks apply only to large multinational banks that have significant US dollar transactions. Can you comment on this, and what would your advice be to banks?
Thank you, Shirish, for the introduction, and thank you to the great audience. Hope everyone is safe and healthy. Also, thank you for leading knowledge awareness campaigns, podcasts, and webinars, Shirish. It adds huge value to the community. Thank you for that. Going back to your question, I would like to define the role of OFAC before answering the question. The Office of Foreign Assets Control, the OFAC, of the United States Department of Treasury administers and enforces economic and trade sanctions based on U.S. foreign policy and national security goals against targeted foreign countries and regimes. Terrorists, international narcotics traffickers, those engaged in activities related to the proliferation of weapons of mass destructions, and other threats to the national security, foreign policy or economy of the United States. So many of these sanctions are based on United Nations also, and other international mandates are multilateral in scope and involve close cooperation with allied governments. So if we read what's the role of OFAC, we can see that nothing mentioned restricts its impact on large banks only. That's a start. And this is a huge misconception, as usually it's linked to large amounts of illicit funds. So people think large amounts, this means large banks. That's surely wrong. On the contrary, criminals use small banks to hide their illicit funds or layer it through the financial system. They take advantage of the fact that the small banks want cash and more business, especially the newly established ones or small branches. So they sometimes turn the blind eye on a strict KYC or certain transfers which offers traditional timely liquidation. Or they may structure, for example, the criminals may use small banks to structure cash deposits to avoid threshold reporting requirements. I'm not talking about all small banks, but definitely there are small banks which they sometimes apply not the required, let me put it like in a diplomatic way, not the required know your customer or onboarding process. So as we said, like Criminals also may structure cash deposits to avoid threshold reporting requirement, as we said. Deposits to avoid threshold reporting requirements may not be as strict and persistently assess this particular bank's compliance program like they do with larger banks. Because sometimes also, unfortunately, in many countries, regulators focus more on larger banks, while they should focus as equally as they should focus actually in an equal manner also on the smaller banks, for the reasons we've mentioned and many other reasons we just gave examples here. Saying all of that, for small banks and other financial services firms, it's not only for banks, also financial services firms, all this means that regardless of your size, you are vulnerable, and in my opinion, more than the large banks. Thank you, Shirish, and over to you.